Welcome to Innovation and Leadership. I'm Jess Larson. On this episode, we get to have Fabrice Grinda. He's a famous entrepreneur, founder, angel, venture capitalist, philosopher, an all-around interesting individual. I'm excited for everybody to learn from him today, but especially me. Fabrice, thanks for coming on.
Thank you for having me.
So, can you talk to people? Let's start with the Fabrice story of building the eBay of Europe and the Craigslist for the rest of the world and super angel turned VC type of volume and give people the overview.
I guess it probably starts when I was 10. I'm French, even though I don't sound French anymore. And I got my first PC. And it was like love at first click. And I knew that computers and I were meant to be together forever. Learned a program, started building BBSs, came to the US to live the American dream and went to Princeton. And I already knew how to program. So I'm like, okay, I'll study mathematics and economics. It explains the way the world works. And when I graduated, the tech bubble was already inflated. And I knew I wanted to be a tech founder, but I was like, okay, not really, I'm shy, I'm introverted, I don't really know business, I'm 21. So I went to McKinsey. It was like kind of business school, except they pay you. I did that for 2 years. And then I'm like 23, 98, bubble isn't burst yet, let's go for it. And I'd studied market design and I liked marketplaces and the idea of like creating liquidity in fragmented opaque markets. Saw eBay, same thing, it was like love at first click. And I'm like, I can build this in Europe. I lacked like creativity to bring new ideas. And so I built it, raised like 60 million in venture money. I was like 23, had 150 employees, grew to 10 million a month. Sold it to a publicly traded competitor, but which was the only person I wanted to sell to. I wanted to sell for a lot less if I had cash to eBay, but my VC made me sell. And the stock of the company that bought us fell 99.98%. So it went from zero to hero back to zero again. And so in 2001, came back and like, you know what? It's okay. I didn't do this for the money. I like building something and nothing, even though the internet is going to be this little niche thing. There's no money in it. This is what I wanted to be doing. So I came back and built my second big tech company. It's a company called Zingy. It was a mobile content company, like selling ringtones, etc. Not actually because I like ringtones, but because like it's a company I knew I could build and make profitable reasonably quickly. And that company went from $1 million in revenues in 2002 to 5 in 2003 to 50 in 2004 to 200 in 2005. So this time I sold it a bit too early, but better too early than too late for 80 million in cash in the summer of 2004. Stayed in ICO 18 months and then went on to build my third big venture-backed company, which is basically a company called OLX. OLX is Craigslist for the rest of the world. It's what Craigslist would be if it was run by a commercially minded capitalist who actually wanted to provide the best service to the community. Moderating the content, mobile first, female friendly, integrated payment, no spam and scam control, and really creating the best user experience possible. And the company grew to 11,000 employees in 30 countries. It's over 300 million users a month. Tens of millions of people make a living off the site every month. And it's the leading site in Brazil and all of Latin America, and like India, Pakistan, all of Southeast Asia, and like Ukraine, Poland, Romania, all of Eastern Europe, and the UAE and all the Middle East. Huge company, sold it to a publicly traded competitor called Naspers in 2013. And at that point, it already made hundreds of investments as an angel, and it was doing really well. And I'm like, you know what? I like building companies. I like investing in companies. Let's go build, a little family office with my co-founder and partner, Jose, just to do that. And that took on a life of its own, and that led to creation of FJ Labs, which is now a venture fund focusing on marketplaces and network effect businesses. We're now investors in 1,100 startups. We were at the beginning at many of the top companies you might have heard of, and we were investors overall in everything from Alibaba to Instacart to Uber to Airbnb. I mean, you name it in the marketplace world. And we've had over 300 exits. It's going very well. We've had on these 300 exits like a realized IRR of 37%, and that's over 24 years of angel investing and venture investing. And it's going well, and it's super fun.
That's exciting. One of the things that was attractive about having you on the show is I got really nerdy into what are the more reliable ways to make money in venture and angel. And so many of the cliches of what you need to do to be a venture investor. I started listening to, I think in the last 9 months, I've listened to maybe 100 interviews of VC LPs. And what the LPs say they want to buy is not what most VCs want to sell. And like one of my favorites, who I think you're spiritually aligned with, there's a woman named Jamie Rose. She was at the DuPont, 10th generation DuPont family office, went over to Screen Door now. And she just went through, like, statistically, how getting very, very broad exposure has the statistical highest likelihood of a superior IRR over the long term versus being a good picker. And I fully acknowledge that people at Sequoia have figured out how to do it a different way. Their circle of competence is different, and they have figured out how to be pickers. And I mean, they do have pretty diverse now over these years, but I've heard you bring up Y Combinator before. Will you just explain this philosophy better than I did?
Sure. So first of all, the FJ Labs is the diversified fund. We invest in over 150 startups every year. The funny thing is, and I'll get to the philosophy and why it works afterwards. It's not the reason I do it is not because it is a successful philosophy, by the way. So it's not a top-down approach. It's more bottoms-up. What do I think is fun to do in life? And what I think is fun to do, kind of like you like to chit-chat with like amazing founders and CEOs and athletes, et cetera, on this podcast. I like to talk to extraordinary founders who are trying to solve a problem in the world. And if it resonates with me, I like to back them. And there are as many founders that there are problems. There's so many problems in the world, like, if we think of like inequality of opportunity or climate change. Climate is not one problem. It's 1,000 sub-problems. And so there are thousands of founders addressing them. And my intellectual curiosity basically drives me to want to back them all, which has led to diversification. Now, the reason that by coincidence, a diversified portfolio in venture, kind of like a diversified portfolio, by the way, in the S&P 500, is the best strategy for a fundamentally different reason. So venture follows something called the power law, where the top 2 deals of a decade represent 40% of the returns. The top 100 deals basically represent 80% of the returns. And so over the course of a decade, you need to be in these 100 deals. And if you're in a diversified portfolio, you're way more likely to be in the deals that lead to all the returns. That said, we play Moneyball, not Powerball, in the sense that for each of the companies I invest in, I care about the valuation, I care about the unit economics. And we've made money in about 40% of the companies we've invested in. And yes, most of the returns come from the top few deals, but we still have to be selective, right? So it's not complete spray and pray, because every week we get about 300 inbound deals and we invest in 3. So there's a 1% filter between the two which we've created, where I've thought through what is the 4 heuristics that we care the most about. But that said, diversification absolutely works. Funnily enough, though, most LPs actually don't necessarily believe it or buy it, or don't think that they should invest in diversified funds, because many LPs are like, well, I'm picking 20 managers. Each manager is investing in 20 companies. I'm diversified. They come to me and my portfolio is 500 companies. I've kind of done their job for them. And so it kind of depends if it's the family office themselves versus if it's someone they've hired to go and do the diversification, in which case their job necessitates them investing in 20 funds.
Yeah, the fund of fund is like, hold on. You've already done my job for me.
Exactly.
It's like, I can't remember who said it, but there's some saying from like 100 years ago, Benjamin Franklin or something says like, it's very hard for someone to learn something they're being paid not to learn.
Absolutely. Absolutely.
So what's interesting though is that 37% IRR, when you look at, from a beta perspective, venture capital as an asset class is often, I think it's Cambridge or whoever has said that it's more of a 25% IRR business. What would you attribute that 13% delta advantage to? Is it primarily that filtering that you just brought up from the 300 to the 3, or what do you think?
There are a lot of things. So what boosts our IRR, so the benefit of being a small shareholder, because obviously if you're an investor in 1,000, we're in 1,100 startups, we only own a couple percentage points of each of them. We write small checks. As a result, we behave like angels. So not only do we decide very quickly, but it means that we're treated like angels. So what happens is, on the way up, when there's a Series B or C or D and we feel the valuation is too high, often there's secondary opportunities, and we've been selling on the way up. So the reason IRR sometimes gets lowered in VC is you have to wait forever in order to exit, and because if you own 15, 20% of the company and you're the lead, it doesn't matter if you're the C lead, the A lead, the B lead. If you want to sell, you're a negative signal, and it basically kills the company. And not only do you need to hold until IPO, you typically need to hold post lockup, and you often own so much of the company you still can't sell. So if you're investing at seed, before you see any liquidity, it's 12, 15 years. It's a long, long, long time. The beauty of owning 2% of the company is if we sell, and we're not a negative signal. And so what's happened is we treat follow-ons as though we were not existing investors. Knowing what we know now, would we invest in the company given the traction, the team, the valuation? What happens is, and by the way, the VC philosophy is double down on your winners, price doesn't matter. We're like doing the anti-VC philosophy. We're like selling our winners. Now, we don't sell all of them. We only sell when we feel that they're overpriced. But what happens is the very best companies have a tendency to get ahead of traction. So if you're at like 100x annual revenues, you may be an extraordinary company, an extraordinary founder, extraordinary traction. It's going to take a while for you to grow into this. And if I can't be underwriting 37% IR going forward, then I'm better off selling. Now, so we've been selling in secondaries on Forge, on EquityZen, on Shares Post, on with brokers on the way up, or in rounds on the way up. And by the way, often the founders ask us to sell as a favor. They're like, hey, I have like Sequoia and Andreessen Greylock, they all want 15%, and they have these roles where they need at least 15%. I don't want 45% dilution, but I want all three of them because I don't want them to back a competitor. Would you mind selling some of your shares? And we're like, we really love you. But for a 10x, we can sell half. And by the way, we typically sell half, not 100%. Because if we sell half, we made 3x, 10x, whatever, we're happy, even if it goes to zero. And if it goes to the moon, we still have 50% to ride, and we're also happy. And so there's no magic number, but it's that rule of thumb that served us very well. And so we sold a lot. And in 21, because we trusted heuristics, we were sellers. I mean, top down, I wrote a blog post saying, welcome to the everything bubble. Because of overly loose fiscal and monetary policy, everything's overvalued. I mean, crypto, SPACs, NFTs, publics, private, real estate, bonds. If it's not anchored to the ground, sell it now. Because as privates we're dealing with, we only sold a fraction of what we wanted to. But when everyone else was going crazy, we were sellers. And by the way, the opposite in 23, 24, when everyone else was like, we don't have any cash, LPs are telling us they're overcommitted, we went pedal to the metal and invested like crazy in everything except AI. Again, you want to be contrarian.
Interesting. Having seen so many wins, so many failures, one of my first thoughts is around differentiation. Obviously, you're doing it yourself, where you're not doubling down on winners, you're selling your winners, like half, these kind of things. And, you're beating the industry average by, basically over half, 50% better than an industry IRR. What's advice that you have for startups who they're doing something similar to the competition, but they believe in the Jerry Garcia from the Grateful Dead, don't be the best, be the only. And so they're looking to pull levers to become more differentiated, and they're looking to become not just better, but different. I know it applies differently in different industries, but do you have any general principles that a founder should be asking themselves when it comes to furthering differentiation?
I think people worry too much about moats, right? Like when you're creating a startup at the beginning, you have no moats. You have no traction, you have no users, whatever you do could be replicated. And your moat is your execution. So the better you are, the higher your NPS, your existing customer base, your retention of those customers, your delighting of them is your moat. And so focus on execution. If I look at the list of the things that kill companies, competition is like number 10 on the list. It's really, really, really low. Don't overthink what competitors are doing. Really just execute well. The three things, by the way, the top three things that kill companies is one, not finding product market fit. You may have a great product, but people are not willing to pay for it. Number two is co-founders fighting. And number three, which is actually counterintuitive, is raising too much money at too high a price. And especially as a first time founder, if someone's saying raise 50 at 250, it sounds like a lot better than raising, 25 at 75. But if you don't grow into that valuation, if it was overvalued, you basically kill the company because there's anti-dilution provisions. No one wants to do down round, and it leads to non-economic behavior often when you raise too much capital at too high a price. And so the mark of honor is, from a founder perspective, should not be the valuation and the amount that you're raising. It's actually the exit that you're getting at the end. That's the only number that matters, and your dilution you've had along the way. And so raise the right amount of money for you on the way up, such that you can get to an exit, and don't price yourself out of exits.
Okay, so for people who are bootstrapping, what's the number three?
I guess related to that, just focus on unit economics. Focus on your burn, right? The point of your pre-seed is to get your seed. The point of your seed is to get an A to get a B, and eventually you get a profitability. And so there are clear metrics in the market of what we expect to see at seed, at A, et cetera. So right at seed right now, you're raising 3 and 9 pre median. The mean is higher because of AI deals and second-time founders, et cetera. And the median is about that. And we expect if you're a marketplace with 15% take rate that you're doing 150K a month in GMV. If you're a SaaS business, maybe you're doing 35K in MRR or whatever, $500,000 in ARR. And with the money you raise, we expect you in 18 months to be at like 750K in GMV with a 15% take rate, or maybe if you're a B2B marketplace, like 2.5 million a month in GMV with a 4 or 5% take rate, or like 150K in MRR if you're if you're a B2B SaaS business with good unit economics. And unit economics that we care about, we want you to recoup ideally your fully loaded CAC on a contribution margin 2 basis after 6 months and to 3x it after 18 months. And ideally, you don't know what the LTV to CAC is because you have negative revenue churn. And so maybe it's 10 to 1, 20 to 1, whatever. And if you're not there, and sometimes it's okay. Sometimes the sales cycles are long. It takes, that the salespeople cost a lot of money. Signing the first contract takes a long time. It's okay as long as you can articulate why you're going to get there over time. And I think many people launch without really thinking through unit economics and business models and customer acquisition channels, and they're using salespeople or using TikTok or Facebook or whatever. And if you don't have economics that work, basically it kills the business. And I want you pre-launch, frankly, to have done a landing page analysis, density of keyword analysis to understand your estimated customer acquisition costs, et cetera.
Yeah. So let's go back through that equation. You had a number of acronyms pretty quick. And for people not from venture, let's explain these, talking about customer acquisition cost, lifetime value, and do that same equation because I think it's important. Let's do it one more time.
Sure.
But explain it to people from outside venture.
So whatever product you're selling, you need to get someone to buy it. And so the customer acquisition cost is how much it costs you to get someone to buy this product. And there are multiple ways you can do that. You could hire a salesperson who then signs X clients per year, or per month. So you can actually divide the salary of that salesperson by the number of deals that they're bringing, and you get a sense of how much it's costing you to acquire each customer. Or if you are selling product online, you're buying ads on Google, maybe you're paying like $1 a click. And then of the people that come and visit, maybe you have 1% that are buying it. And so that's a customer acquisition cost of $100. Now that's great. That's how much it's costing you to get a buyer. Then you have to understand how much are you making per buyer. And so it's a combination of what is the average order value times the margin that you have in that product. So you're removing all the variable costs. So you're not removing your fixed costs. You're just removing credit card fees, cost of goods sold, et cetera. And that's your contribution margin per transaction. And so then how many times is this customer buying this product over the course of 12 months? 1 time, 3 times, 12 times, whatever, depends on the business model you have. And then you compare those two numbers. What is your contribution margin over the first 6 months or 12 months versus your customer acquisition costs? And if your contribution margin is positive, then relative to your customer acquisition costs, that's fantastic. It means you're creating value. And it means whatever you're doing, you should do more of, whether it's hiring more salespeople, spending more money on TikTok or Google, or creating more content for people to come in, or spending money on influencers. And so that approach and analysis matters tremendously, and many people are not numbers driven enough to understand how to create a good business.
Yeah, that was actually going to be my next question is, when you think about the non-venture world of business, profitability is not like an optional thing. It's so fundamental. Why do you think that can get lost in startup land? Or why do you think that there can be such an underemphasis on it in certain people's minds?
First of all, that has changed. Their emphasis on unit economics has improved dramatically since the day that money is not free. So money was free if you wanted in 21. And so it was growth at all costs with the idea that you can figure it out later. And there are a few examples in history where there was no business model and they figured it out later and created tremendous companies. And that Google was an example of that. Facebook was an example of that, where neither of them launched really with effective business models, but they figured it out. And so there was a belief that if you have enough of a scale and an audience, eventually you're going to figure a model that works. Turns out that happens occasionally, but rarely. And there are many businesses that grew to scale, but actually didn't figure out their business model and ultimately died. And so because I like to I like founders who both are visionary but know how to execute. The way they think through the business and understanding of their underlying economics matters to me. Is, do I believe they're going to be able to execute, and at least having a sense of how to make money. That said, for the first few rounds, venture capitalists don't expect you to be profitable. As I said, the point of the money I'm giving you from pre-seed is to get a seed. Seed is to get an A is to get a B, maybe a profitable B. And if not, it's C to get profitability, and then you have a path. Do you go for scale or do you go for profitability? That said, I do care with the unit economics. So you're not covering your fixed costs, you're still losing, but you need to be building a business that ultimately will be valuable. And because it's okay to be money losing for many years, sometimes people forget that they should actually have positive unit economics. And the issue is, can I scale a business and revenues extremely quickly if you give me $1 and I give you 2 back? The answer is yes. A lot of people will take that deal, and so I can grow revenues very quickly, but ultimately that is not a valuable or interesting business.
Yeah, that makes sense. A question that is infinitely interesting to both founders and to fund managers is always around fundraising. When you think about securing LPs for a venture fund, what are some of the rookie mistakes you see other people make?
So I'm not the one who deals with I do the razzle dazzle pitch to the LPs, but like the full process of, look, the way you should run your fundraising, whether you're a founder or you're a fund manager, is you have a funnel. Top of funnel, the funds that you're talking to, you should track in your CRM where you are, who you've talked to, the last interaction, where you're at in the process. So let's say I'm fundraising as a founder. I want to run a tight process. So I'm going to first map out the right VCs to talk to, and for the stage of the company I'm at and the category I'm in, and people that have not backed my founders. So the big mistake you make as a founder is reach out to VCs that are in the wrong stage, in the wrong industry, or have already backed your competitors, And so maybe there's a list of 20, 30 that you want to reach out to, ideally with a warm intro. And you can typically find someone you're connected to. And then you run the process, and you're like, look, I've started fundraising. You have all the first meetings, the first 2 weeks. You see which ones you get a second meeting to get a party meeting, to get a term sheet at the same time. Arguably, it's easier as a founder than as a GP or as a manager of a fund, because there's a clear deadline you're getting towards, which is probably cash zero of your company. And there's a 2-month, 3-month process during which you're fundraising. As a fund manager, the LPs often want you to have relationships with them and hang out and take them to dinner for like years before they invest. But that said, I would still have the same thing. Full funnel. I would only approach family offices or institutionals that are interested in the model that you're in, that are interested in new managers that cover what you do. Like, I've come to realize, if I talk to a manager and they're like, I don't believe in diversified strategies, which is a lot of them, that's it. I'm done. I don't need to continue the conversation. I don't need to continue. It's like a waste of time. Convincing someone who's never invested in tech and venture that they should be investing in venture, same thing, waste of time. It's way too hard. Way better to go after people that believe in the approach you have, that believe in the asset class, and ideally that you have prior connection or relationship with. But same thing, I'd run it as a sales funnel, top of funnel, where you are in the funnel, build a relationship. Once you're ready and you're shooting for a first close, I mean, there's lots of tactical things you could do, right? Like, the way LPs work is they typically have a budget, and they allocate at the beginning of the year. Usually by the end of the year, it's spent, right? So try to shoot for your first close or your close to be in January. So go to market in like November, December. Have your deck and data room fully ready. Make sure your numbers are audited. Use completely standard documentation and LPACs. Like, do everything standard to make it easy for people to say yes. And too many people make it hard and target people that are not right for them. Same thing with VCs. When I get someone pitching me a hardware business that's Series D, it's like, okay, I don't do hardware. I may consider it late stage, but it has to at least be network effects, and I'm mostly seed and A, right? Like, it doesn't make any sense.
Yeah. What's another principle for effective fundraising?
So the people, I think this applies to both LPs, for raising from LPs and raising as a founder. be a storyteller, or like you should have a deck, you should share it. Like people, I don't know why they're a bit like, I need an NDA a lot. It's not the way venture works. Send them the deck, send them the information, have them do their homework ahead of time if they want to, and just it's a conversation where you come in, you're telling them a story, and then you take them on the journey. And so storytelling skills, I think, are absolutely key, and making people dream of whatever vision you're trying to accomplish, be it as an investor, because ultimately you're trying to solve problems by investing in companies that are solving problems, or as a founder. And so I think storytelling skills and focusing on the narrative, but it has to be authentic, and it has to be authentic to you. So it needs to come naturally without like being stilted. And like, I never, unless someone really insists, like open a deck and like walk them through the deck. I just tell them the story. And if there's something that they want to dig deeper in or have support for, then we can open the slide that is relevant. But this is a conversation.
Why do you think not enough people tell stories?
The art of oration and narration is, it's an art, and it's not taught effectively. The amount of, most people are afraid of public speaking. Most people are, and so it's way easier to speak in like bullet points and like whatever your talking points are than to just on the cuff, like, tell a compelling narrative. And most things, I actually think, have narrative arcs and fundamental stories. Like if a founder is building a business, there's usually a reason. It's not just, oh, it's a good business. It's like, their parents faced a problem and they wanted to go and fix it, or it annoyed them so much that it compelled them to do something about it, whatever. And these are interesting stories. And humans love stories, right? Like all of, if you read Sapiens, right? Like everything, the civilization we build in is based on stories, and the stories we tell ourselves, right? Borders don't really exist. We've made them up. Currency doesn't really exist. We made it up. These are all stories we've commonly agreed to accept as real. And yes, I guess fundamentally, I think in high school, we should be teaching people storytelling. Well, we should be teaching a lot of things, including financial management, how to do your taxes, etc. But definitely storytelling, which I think plays a fundamental role, should be part of like, public speaking, etc. Should be a greater part of our educational system and processes.
Yeah. Thinking about lifetime investments, how many different investments do you think you've made, and what do you think like approximate total capital invested would be over lifetime for you and across the funds and the different angels and guesstimate?
So not including the companies I've built, we've invested 678 million, 378K investment on average in 1,100 companies. And yeah, they're worth like whatever, over $1 billion right now. So yeah, 1,100. So 1,100 is unique companies. So some number of investments, because sometimes we follow on in companies. So investment decisions is in, let's say 2,000, because we followed on multiple times in many companies. But unique investments in companies, yeah, I think we're at 1,178 or something like that. So let's say 1,100, overall 1,100.
Yeah. Thinking about, Alibaba, Instacart, Flexport, some of these real standouts. What are one or two commonalities or traits that you see amongst these unicorn founders?
Most of them had extraordinary storytelling skills, and they could explain very effectively how they were going to execute. And so I actually, right, the Venn diagram intersection of founders that are visionary storytellers and know how to execute is actually small. You either have like the people that like know the numbers but can't tell a story, or the people that can tell a story but then they can't execute. And so they had both of these things, and that was unique. And they had an amazing vision trying to solve a very big problem. I mean, Ryan at Flexport, extraordinary storyteller, but like also understands the problem and goes in the weeds of how he's going to go about it, fixing it.
It's funny how simple that sounds. Yeah, like simple but not easy, right?
Absolutely. And by the way, that's why I defined very clearly what a good founder is, because most VCs are like, oh, I only invest in extraordinary founders. But it can't be like porn. It can't be something, oh, I know it when I see it. And so that's why I codified it as, okay, extraordinarily eloquent. That, of course, comes across pretty easily, and knows how to execute. That's harder. And in our case, we evaluate companies in 2 1-hour meetings. And so that's why I bring it back to, okay, explain to me total addressable market size, the unit economics, the customer acquisition cost, and the way they walk me through that comforts me or not in their ability to actually execute.
Yeah, yeah, that's great. There's so many ambitious entrepreneurs who have not built big successful companies like you've done multiple times. There's so many ambitious, smart people in the fund business who have not deployed $678 million across 1,100 plus investments. What do you think is different about you? What do you do that not everyone else has done? Why have you been able to succeed in ways that other smart, hardworking people have not been able to?
Look, there are a lot of factors, right? Like the right time, right place, right skills, right? So falling in love with computers in 1984, when ahead of the curve, if you want, where there were only two role models in tech at that point, which was Bill Gates and Steve Jobs. When the 90s tech bubble started exploding or like inflating, again, I had the right pedigree with the right skills in a moment where the world valued youth and those skills. And then ambition and thoughtfulness, and I have those oration, the skills of public speaking and oration and attention to detail that has allowed me to execute. But as I said, like luck plays a role, right? Like I didn't. It's not as though in 1984 when I said I was like, based on future macroeconomic trends, clearly tech is the place to be. No, it was my hobby, and it just so happened that my hobby turned into $1 trillion industry. If my hobby had been, whatever, playing the flute, I would not be where I am today. And so because ultimately the people that have a tendency to be the most successful in these industries are the people that do it for fun. You're not doing it for the money. The people doing it for the money, eventually they burn out because they're competing with people like us who think it's fun. I spend my free time like coding my own AI and like coding my blog posts and thinking and reading and writing about this because I think it's fun. It's not work. And so the people that are doing it for the wrong reasons, I think ultimately get weeded out versus the people that are doing it through passion. But you have to be lucky enough that the passion you choose is one that the society values. There are many passions out there that are not valued financially or monetarily by society. And it's also true of the companies you choose to build. There are many companies out there that people have built that just were not able to monetize because people were not willing to pay for the service. And so you need to also have a connection to what the world values monetarily. And so I can't remember, but there's this Japanese philosopher that said you should pursue the category where, it's something where you have like differentiated expertise that you love and can monetize. But you need that part. Otherwise, it's just a hobby as opposed to something you can turn into your business. And so it just so happens that the things that I've loved, like studying economics and marketplace design and building tech companies, is something the world is financially valued. And there are network effects, right? Like once you're successful once, it's easier to raise money the second time, right? When I sold Zingy, so first of all, when I was trying to raise money for Zingy in 2001, every VC I called, I don't think I'd finished the sentence that I'm doing BDC telecom that they'd hung up the phone. Couldn't raise a penny for the life of me. Even though 2 years earlier, all those VCs were throwing themselves at me to like invest in my startup. All of a sudden, my company becomes very profitable. Then they all want to invest. Of course, I need the money so I can take it. I sell it, do very well. And all those VCs then said, okay, whatever you need actual fund to. So for OLX, I raised 10 million at a 28 million valuation in 2006 on a PowerPoint, pre-launch, which obviously even today is an extremely high valuation, but that's because I've been successful before. So in a way, it gets easier. And because I've been so successful as a founder, and I'd already invested all my money in many startups, and again, I invested in startups, not because I thought it would be a great way to make money. It's because founders started approaching me when I was in 98, and they're like, hey, we love what you're doing. You're facing all those problems. Can you help us? And I thought long and hard, should I be an angel? I mean, it is a distraction from my mandate as CEO to be an angel investor in other companies. And ultimately, I'm like, okay, if I can articulate lessons learned to others, it makes me a better founder because it means I've internalized the lessons. And number two, I'm an investor and I'm a founder CEO in a horizontal multi-category site. Maybe having my fingers on the pulse of the verticals makes a lot of sense. And as long as I do it only in categories that I know, so marketplaces, and in a 1 hour meeting with 4 selection criteria, I'm going to decide if I invest or not, it's fine. The thing is, by 2013, even though I was running a 10,000 employee company, I had almost 200 investments, dozens of exits, it was working really well. But I never intended to build it like that. And then, again, that took on a life of its own. If you're a super successful angel, becoming a VC is the step function from one to the other is not that hard. That said, fundraising from LPs was hard, and that took a time. We still haven't had our first institutional investor, and we're about to go to raise fund 4. I'm hoping for the first time to have institutional. No one back in 2013, at least, was giving me credit for my angel track record, even though I'm doing the exact same thing. So it makes very little sense. But that said, having personal capital helped for sure. I'm the biggest LP in my own fund, right? We've raised over 600 million, and I'm over 100 million of that, probably near 150 of that.
Yeah. I think it's so valuable that you have reflected enough to be able to delineate these things, because it helps the rest of us start to add it to our own equations and try to change it for what we're up against, but keep the principle, change the circumstance,
Yep.
Another one, maybe, you spent so much of your life in marketplaces, platforms, these type of network effects businesses. What are 3 top principles for you when it comes to marketplace success?
I'll tell you the biggest mistake marketplace founders make. It's typically reasonably easy to get a seller to list on your platform. If you go to them and you're like, hey, I have this new platform, don't really have buyers right now, but it's free to list, we'll take a small commission, do you want to list? Everyone says yes. And so it's very, very easy to overflow your marketplace with infinite supply. Then you don't have any demand for, so the supply is unengaged, they churn, and when there is a buyer, because the supply is unengaged, you have a very bad experience. The much better way to do this is you get the very best supply. And it doesn't matter what it is, whether it's a service provider, whether it's a seller of an item, the right product at the right price, the right service at the right price, and they're available. And then and very limited supply, very curated. And then you find buyers for them. And the buyer's happy, they're happy. And once they're at capacity, then you add more supply. And so you really scale in parallel supply and demand in a way that they're always matched. And you always have liquidity. And liquidity is typically, if you're selling a used good, you have at least 25% probability of selling it. If you're a service marketplace, you represent at least 25% of the revenues of the supply on the marketplace. And you just scale with liquidity. And so focusing on that and not breaking that dynamic and really matching supply and demand makes a lot of sense. And that's really probably the key success factor in marketplaces. And of course, you need to acquire both sides with good unit economics. Now, in terms of everything else is random. You can figure it out. Like, what is the business model? Do you take a commission on the seller or the buyer? Or maybe the elasticity of supply and demand is such that it's so elastic, you cannot take a commission. Instead, you do financing and you take a margin in financing, or you do value-added service. You put an escrow, or you create a SaaS product and you sell a SaaS and you charge a SaaS fee. So the business model is independent from the marketplace dynamics. Nail the marketplace dynamics, make sure you have liquidity, and wonderful things will happen.
Okay, this is great. I love that you're boiling it down so much. When you think about attracting buyers, besides having great supply, besides having attractive supply, what other principles would you give to a founder?
The answer is always it depends. Some products are considered purchases, in which case you may need a high-end sales team that goes and finds the large enterprise that are buyers. Some companies you have telesales, some people you have in-person sales, and some you have paid marketing. Some VCs are anti-paid marketing. Actually, I love paid marketing. If you can make the economics work with paid marketing, the easiest thing to do is spend more on marketing. And so it's a very valuable and easy way to scale. Now, after Apple stopped tracking in Facebook ads and Google ads, the customer acquisition cost has gone up for most people. But if you can make the economics work despite that, then that's amazing. So demand is actually the hard side, because I said sellers are financially motivated to be on the platform. So 95% of the cases, the issue is getting demand in a cost-effective way. And the answer is you try everything. Influencer marketing, referral programs, SEO by having a lot of content. So content marketing, paid through every channel possible, including TV, sales team. It doesn't matter. I'm channel agnostic. This is literally it's a spreadsheet game. Make the economics work. The economics work, just scale that.
Yeah. Thinking about those experiments to figure out which one the economics are going to work best at. Any thoughts of the balance beam of giving up too early versus over investing after this is a dead horse and you should quit beating it?
It takes very little money to do any of these tests. Like, I can test a basic CAC analysis for like $1,000, so because $1,000 at a dollar a click and 1% conversion rate, or 1% click-through rate on an ad to your site, you're still getting like 100,000 impressions. And so it's good enough 100,000 impressions is good enough to get a statistically significant number. So it takes very little money to actually figure out whether something's going to work or not. And if you're like 20, 30% off, you're going to figure it out. If you're an order of magnitude off, that's not going to work. There's nothing you're going to do that's going to change the effectiveness of that channel by an order of magnitude. And so understanding how far off you are gives you a sense of whether or not you should keep playing at it. But like, yeah, if you're almost there, yes. Do I think we're going to improve the funnels and you're going to target better, to the point that you're going to get there? Yes, absolutely. If you're an order of magnitude off, nothing you do is going to get you there. You can improve by 20%.
Yeah, that's such great advice. By the way, have you written a book?
I have not written a book. I write a blog, which covers everything and anything from good unit economics to my current philosophy to improving productivity in your personal life by outsourcing to book review. I mean, so it's basically whatever's on my mind right now, I write. And yeah, I love writing.
Okay. What's the website for your blog? Where should people follow you on LinkedIn? If people want to find out about your fund, where should they go? All the things.
So my blog is just my name, fabricegrinda.com. The fund is fjlabs.com. Best way is to reach out to me on LinkedIn, where I'm also Fabrice Grinda. So reasonably easy. That's
great. What do you want to leave people with today?
So the reason I do what I do is the world is if in a way, is full of problems, right? In the 21st century, we're facing three fundamental challenges. We have climate change, inequality of opportunity, and the climate and well-being, the physical and mental well-being crisis. And I find that like the governments writ large are structurally incapable of addressing the challenges of our time. And if I think through over the last 200 years, where we've seen this extraordinary improvement in quality of life, right? We're like 200 years ago, we're all farmers working 80 hours a week with a life expectancy of 29, going hungry multiple times a year, to the life we have today where we have like running water and flying planes and we have the sum total of humanity's knowledge in our pocket. We have like a super intelligent assistant and we have free global video communication. So better communications information than the president of the US had 25 years ago. All of that has come through technology. And for me, technology and the deflationary power of technology and its ability to improve user experiences is the vector by which we're going to solve the world's problems. And that's why I do what I do. And it touches, it's global in nature. And I'm so profoundly optimistic. We are going to rise to the challenge of the 21st century and use technology to solve all the world's problems. And we're going to build a better world of tomorrow, a world of equality of opportunity that's sustainable. So yeah, beyond optimistic.
I appreciate that, and I love that attitude. Our charity, we've been running Child Rescue Association for 15 years, right? It can be depressing to hear these stories of how people are hurting each other. But there's also an optimism of we currently, in the world, have the lowest percentage of slavery in history. Like, this is progress. Even though there's a lot of work left to do, on a whole, that's pretty optimistic. That as a percentage of the globe, that number keeps going down. I love that.
That's true, by the way, on every metric. Percentage of humans killing each other is the lowest it's ever been in history. The percentage of people in extreme poverty going hungry every day is the lowest it's ever been. On every fundamental metric, quality of life is better than it's ever been. And yes, this is not a Pengelosian view. This is not, we are in the best of all possible worlds. Absolutely not. Actually, Pengelosian would be the best of all worlds. Likeness is the best of possible worlds. But no, we have a lot of work remains to be done, but we have made a lot of progress, and technology plays a huge role in helping that progress. And I hope to be part of a vector of continue to make it, to bring the world, a better world forward, basically.
Well, and I think that optimism is actually fuel, right? Like, if we weren't winning, it's easier to give up and think, nothing I'm going to do matters anyway. But like the fact that we're winning, polio is at the lowest numbers it's ever been. Like you said, poverty reduction, right? It's like, well, since we're winning, let's finish this off. Let's let's
I agree. It's
push
interesting.
hard.
Most people don't feel that way. But then again, most people are not students of history, and they have rose-tinted glasses when it comes to the past. And like, oh, things were used to be better in the 50s and 60s. That's absolutely not true. If you were African American or a woman, I mean, if you're a woman, you toil away at home. Like, what has freed the women in general was actually the invention of the washing machine, right? That it actually allowed a big percentage of the women to enter the workforce beyond changes in cultural mores, et cetera, that have played a role. And people were like, "Oh, today is the most whatever partisan, horrible time in human politics in American politics." I'm like, that's not quite true either. I mean, we had a full-on civil war, and let's go back to the 1960s, like race riots, the 1970s, like full-on anti-war protests that were violent. Today is actually we're living in relative peace. It's just people didn't live through these times, so they don't know how it was. But it was actually way worse. I mean, we had like Nixon as president. He's like things were pretty bad.
Yeah, well, and the problem too is the negativity is so amplified because it sells a lot of ads, right?
Oh
And
yeah,
so
I mean,
the awareness of the negativity is very high.
Yeah, it's
even
a feature of
even
our
if
brain,
the percentage
right?
is lower.
10,000 years ago, if there was like a ruffling in the wheat, it might be the tiger that would eat you. And so it's better to be attuned to negativity. So our amygdala is oversensitized to negative information. So my solution, by the way, is I don't consume any news whatsoever. I don't follow politics. I don't read newspapers. News is sensationalist and negative, and it's like a virus for your brain. It's like negative entertainment. It is only entertainment. It's repetitive, and it's trying to create outrage, and it's trying to attract these negative emotions in you. It actually misses the broader stories, right? Because these broader stories take a lot longer time. The fact that poverty is decreased by, a billion people came out of poverty over 40 years. Well, it took 40 years. So it's not like the news cycle of the day of like whatever outrage some person said or did or whatever, who was murdered. I mean, all these things over time are irrelevant, but human attention span is different. So ignore the news, read books, and like look at the broader trends of history, and you'll be way more happy.
Okay, give us, to finish off here, give us an optimistic book to read.
An optimistic book to read.
Or just an important book to read, either way.
So I read. So I don't read that. So I read a lot. I read about 50 to 100 books a year. My routine is I read an hour and a half before bed every night. But I read for fun, and I read to make myself dream. So most of the things I read are like science fiction and fantasy, and they're like beautiful, amazing stories. Right? Like, so my favorite sci-fi book of the last 5 years is let me find the name. I should have it handy. It's Andy Weir's latest book. It's Project Hail Mary. An amazing, well-written book that's just like beautiful love story of the love of like video games and you don't need to like video games, by the way, to read the book. It's called Tomorrow, Tomorrow, and Tomorrow. Probably my favorite book of 24 and came out in 24 or maybe 23. In terms of important books, I don't know. I don't like the so-called important books. Now, do I think there are a lot of amazing books out there that are worth reading, like Sapiens, or a short story of nearly everything, which is actually not about everything nor short, by Bill Bryson? Absolutely. Not sure they're particularly optimistic though. The Steve Pinker type books are more optimistic because they're like broad swath of history and like, oh, things are getting better. But obviously they're also somewhat biased. So I don't know. I read for fun. All the businessy type books I think are like one trick ponies. That's like one idea repeated 50 times over. It works. It's kind of like the self-help book, but are they that interesting? Not really. And by the way, that's the reason I haven't written a book, right? Because a successful book today, you really want to be pitching one idea and like one concept, and then you thread that concept throughout a full narrative arc and maybe through your life if it's biographical in some way, shape, or form. But I don't think that's the way the world is. I don't think that's the way humans are. We contain multitudes. I am not just a tech founder and a venture capitalist. I also read a lot, and I kite surf, and I'm a parent, and I heli ski, and I play video games, and I have a billion other interests. I go to Burning Man, occasionally I think it's fun to drop acid. and all these things make me the individual. And I think a book I would write would have that level of diversity, and it's not actually what resonates with the public. So the
Well,
polymath of the world or I think valuable, but not valued.
I love it. Well, listen, thanks for spending so much time with us today.
Thank you for having me.
Okay, bye everyone. Thanks for listening.